Hi, I'm Dr. Kevin Milo, and you're listening to the Physician Empowerment Podcast. At Physician Empowerment, we're focused on transforming the lives of Canadian physicians through education and finance, practice transformation, wellness, and leadership. After you've listened to today's episode, I encourage you to visit us at phys-empowerment.ca, that's PHYS, empowerment.ca, to learn more about the many resources we have to help you make that change in your own life, practice, and personal finances. Now on to today's episode.
Okay, all right. So welcome everyone. So excited to see or hear everyone to kick off 2025 February, right? So this is February, and we have a brand new talk on real estate investment financing landscape and how that. What's the basics? What are the updates? So we're really glad to have Gaurav. He's Gaurav Sobti. He's got many titles. He's a CA, CFA, CPA, and lots of titles. And he's got lots of credentials. He used to do a lot of institutional level of investing, due diligence and whatnot. And now he's doing a lot of financing stuff, commercial financing. So thank you for joining us, Gaurav. I know you're extremely busy and your wife is a very busy physician as well, and you've got two little ones. So thank you for joining us.
Thanks for having me.
Okay, so Gaurav, let's dive into that. So this episode, we want to let our audience kind of get the brain juice going about real estate financing. Now, of course, most people's personal experience with real estate financing, everybody has some, right? Unless they're just renting. Everybody has some, and they tend to believe, okay, because I got a mortgage, because I have a banker, the banker said, hey, with your medical degree, I can give you a really nice deal. And they thought when they start to do their real estate investing career or path, everything is going to be smooth ride, right? So can you tell us what is the investment landscape, financing landscape like out there? Like what are different kinds of financing out there for real estate investment?
Yeah, sure. So yeah, like most people, like you mentioned, like they're used to sort of single family home financing, right? That's you're mainly getting qualified based on your income, right? So I have clients coming to me all the time who are saying, hey, we're capped out, because that type of lending is sort of based on TDS and GDS calculations, right?
So what are those? What are TDS and GDS?
It's more of a residential thing. I mean, TDS, it's just like a debt service. Like, you got to add up all your expenses, all your debts, right? Personally. And then they look at sort of your personal income. And I believe it's like, 30, 40%, right? You kind of get maxed out at. If you have a rental property, then if you have rental income, that kind of offsets it. That gets counted in the numerator versus the, and the denominator, right? So yeah, I mean.
So those are scores that you can pay to get them online, right? Or they're free, but every time you check it, it kind of affects your own score, right?
Yeah, exactly. Well, lenders look at it, right, on the personal level, right? Like based on your personal income, right? Then some lenders can kind of look beyond, your T4 income, right?
Right.
And kind of factor that in, right? But, commercial lending is primarily, based on the property, right? The borrower or the sponsor, we would call it, has an impact on, whether you'd qualify for a loan. But first, they're going to look at the asset itself, and they're going to see, okay, can the asset debt service, right? And various different types of assets, right? Whether it's multifamily or commercial, let's say like retail, industrial, they have different debt service coverage ratios, right? Which is the ratio, the income of the property, the net operating income of the property to the payments, right? The projected payments. So for example, on multifamily, there's different types of financing for multifamily, CMHC, non-CMHC. For CMHC, you can go as low as a debt service of 1.1, right? Whereas like a typical commercial deal, a non-CMHC deal, would be 1.25 times.
So let me just backtrack what that means. So we're digging into some ratios, jargons. I don't want to get lost into the weeds, right? But basically, you need to Debt service, that means you need to pay the mortgage, right? Pay the mortgage every month, and your income has to be at least above what you owe them, either by 10% or 25%, right? That's ESCR, right?
So the reason they do that is because, I mean, there can be fluctuations in the income, right? So they just want to have a bit of a buffer.
So before we deep dive into those, can we go back a little bit broader, like the financing landscape? So other than everybody's experience with the personal home, when you go into rentals and into commercial loans, so who are the lenders? Like other than your bank or a bank, a type A bank, what are the lenders out there?
I mean, the credit unions will lend, right? The insurance companies will lend.
Even insurance companies will lend. Most people don't know about that.
Yeah, credit unions will lend. Then there's like a whole bunch of, non-bank lenders. I work for one called Peak Hill, for example, right?
So these are called the private lenders or
they're non-bank lenders. Like they have various forms of financing, right? So they may have they may do some activities that a private lender will lend at.
Right.
But they also would do, for example, more A lending or bank lending, right?
Right.
They're very active in the CMHC space as well, right? Some of the largest lenders in the CMHC space are non-bank lenders, right? Including the firm that I'm currently with as well.
Right. So therefore, if we just think about just a big bank that you go to with a brick and mortar, your lens is too narrow, right? There are other lenders out there. They may be a little bit more expensive. Some of them may be cheaper than your own banker as well.
Oh, sometimes, yeah, like sometimes they can have sharper pricing, right? For example, Royal Bank, right? If you talk to people from Royal Bank, they'll tell you, sometimes Royal Bank will have the best rate for CMHC. Sometimes they're wide by 1%, right? A year. So it's like their capital is always fluctuating, right? And the landscape in Canada is pretty large. I mean, in the US, it's even larger, right?
Yeah, of course. That gets even more complicated. Let's focus on Canadians because we're mostly Canadians. So then there are a lot more lenders. Yeah. So why is it not advantageous to stick with just one, like you just have relationship with your banker who you are tight with? Why is it
Well, yeah, I mean, you don't know if you're getting the best deal, the best terms, right? Lenders can be in and out of the market, right? So, you might not want to always have all your eggs in one basket, right? Lenders have different appetites, like, especially here in Alberta, right? Like sometimes, the Eastern-based lenders, they might pull back, right? At certain times, right? So yeah, there's a whole different market out there, right?
So I can tell from personal experience, this is way back, just my personal mortgage. I'm starting to understand that there are brokers out there. So I was with this TD Bank in Shore Park forever, right? The branch manager, I knew them really well. They said, as a best loyal customer, I'll give you this deal for the financing. Then I talked to the broker, which was in Interior BC, ended up matching me with the TD Bank in Burnaby, BC, like Vancouver, with much better rates than Sherwood Park, Alberta. I said, what the heck? Why was that? Well, I can't understand, but even within the same bank, even a different branch, it could be different, let alone different lenders.
Yeah, I know, 100%. Yeah.
So let's keep going. And so when you have a broker, right? So then who pays for the broker?
Well, I mean, on the residential side, it's paid for by the lender for the most part. Again, I'm not an expert when it comes to residential financing. And when I say residential, I mean like houses, right? Like your own personal mortgages. Yeah. I am an expert when it comes to CMHC financing, which is residential, but I kind of call that residential, commercial, or multifamily, right?
Because once there's so many doors, it's commercial, it's not residential anymore.
Yeah. So I think on the residential side, it's typically the lender. There are some lenders that will deal with brokers. There's some lenders that won't deal with brokers on that side. And whether you use a broker or you don't use a broker, it's going to be the same cost, right? Generally, right? When it comes to commercial financing, that is paid for by the client. Now, there is sometimes the ability to, build it into the rate, right? But ultimately, the client pays.
So when you say the client, is it the seller or the buyer?
The buyer or the developer, right? Yeah.
Right. Yeah. So the buyer, so you flip the coin, right? Because before, as a buyer, you don't have to pay a dime for anything, right? You don't have to pay for the realtor or the mortgage, right? But now, actually, the applicant, right? If you apply for the mortgage, you have to pay, and you have to pay the financing fee, and you have to pay for the bank to actually
There's
open
lending fees as well. Yeah.
Exactly. You keep paying, right? So it's different. And what's the interest rate of commercial versus residential? What's the difference?
Yeah, I mean, look, if it's not like if it's residential lending versus non-CMHC lending,
Mhm.
then it's probably 1 to 2% different, right? It varies.
It varies. Yeah. Yeah. Now, before,
Like just to give you an example, maybe a good mortgage rate, rates have also come down quite a bit over the last
yes,
weeks, right?
yes,
But maybe a good mortgage rate on a residential is 4%, right? Give or take, right?
right.
Today, the bond rates are like for a commercial deal, the 5-year GOC, right, is 2.7% today.
That's Government of Canada overnight.
Government of Canada bond, right?
Yeah.
So that's sort of the benchmark, right? And then lenders take a spread on that. So for, a commercial deal, like let's say a retail strip plaza or industrial,
Mhm.
you can get sharper than this, but I would say 200 basis points over might be like a decent rate. So, that's like 4.7%.
So 200 basis point is actually 2%, right?
200 basis points is 2%, yes.
Yeah.
So, that might be for 4.7%. Now it fluctuates, right? Sometimes spreads narrow and sometimes they widen, right?
Right. Let's
Whereas, like if you did a CMHC deal, again, it depends on the size of the deal, right? I would say maybe CMHC deals vary a bit more with the size of the deal.
Right.
But 5 years CMHC is priced over something called CMB, which closely follows Government of Canada bond. It's Canada mortgage bond. And so
Right.
that today is 2.94%. And, let's say you had a couple $1 million deal, like let's say 3 million, then you might be sitting at 4%. So if you're just comparing that 4% to that 4.7, right? So there's still some savings, right? Because
Yes.
CMHC, and we'll get into CMHC, that's a whole topic on
On
itself.
topic, yeah.
But yeah,
step down a
CMHC
little
is
bit.
backed by the government, right?
Right. So I guess I just want to stress a point because a lot of listeners are really, this is new to them, right? They've never heard of anything like this other than their own mortgage, right? And just thinking about buying a condo or fourplex or multiplex or multifamily, right? So they don't know about this, but I think I just want to backtrack and have you highlight again the difference between just prime rate, right? Because most people just follow prime rate. Right? But then your mortgage rate or lending rate is not the same. It's not just prime plus prime minus, right? Because
it's based on the bond market.
Exactly, it's totally different fish. So right, so people need to understand the bond market if they want to know where the interest rate is going, right?
Yeah, and I mean sometimes they can diverge, right? Like generally if the overnight rate from the Bank of Canada is getting cut, bond rates will trend downwards, but the bond market is just like it's like any market, right? There's buyers and sellers, right? So there's a whole bunch of factors that go into how people decide what they want to pay, right? Essentially, like sometimes, they say the bond market is forward looking. So, the rate cuts that people are projecting, they already get priced into the bond market, right? So you might have a cut on the Bank of Canada rate, which affects the prime rate, and the bond market might move in the opposite direction on the day of the announcement.
Exactly. So it's not intuitive just to follow the prime rate, right? So that's not the only thing you want.
Yeah, because prime is that rate is influenced by government policy.
Exactly. Yeah. So, but yeah. So most people talk about prime because their personal line of credit is based on prime or their mortgage is prime minus, right? But when you look at the actual rate, it isn't. Okay, let's move on. Let's think about this lending process. Okay, so of course we have all done our mortgage application. We know kind of how painful it is. But when you go into real estate investment lending, how different it is. Like, Gaurav, can you highlight us so that we get prepared? What are they looking for the lending process?
Yeah, so I mean, you typically need like an appraisal, right? The appraisal, you order it, you pay for it. right? Whereas I think on the residential side, you might pay for it too, but they'll arrange it. It's a lot cheaper. You know, residential appraisal might cost you $250 to $500, right? Whereas a commercial appraisal is going to cost you anywhere between $3,000 to $5,000, right?
Or more, depending on how big the property is.
And yeah, you know, you got to be careful too. Like, not all appraisers are accepted by various lenders, right?
Okay.
So you have to think about that as well. You know, you're going to need a environmental report, right? So we call it a phase 1 environmental, just to make sure there's no environmental issues, right?
So this is when you buy a commercial property.
Buy a commercial property, yeah. When you even buy an apartment building.
Oh, that's true.
As well.
Yeah. Instead of like a condo unit, if you buy the whole multiplex, right? You have to do that environmental.
You know, if you're buying an existing property, typically you need a building inspection report, right? We call it BCA, right? And you know, that could run you anywhere between $4,000 to $6,000, depending on the size of the property, right? Even more, right? And so typically these costs you have to bear, in some cases, before you know you're even going to get approved, right? Because they need these reports in order to get approved. So in commercial financing, you have to budget for due diligence cost, right? And you have to recognize that you may have to spend these costs and you may not get approved, or you might not even move forward on the project yourself, right? So, you know, we call these broken deal costs, right? And you have to be ready to bear them. They're just a cost of doing business, right?
So what would be a fair budget for that? For this?
Yeah, I mean, you know, you can kind of do it in stepwise fashion sometimes. Like sometimes you can get away with not, you know, maybe ordering an ESA. That can be like a condition of financing, right? I mean, but then, you know, when you're tying up these properties, you have condition periods, right? And then you have financing periods as well. And sometimes they're run concurrently. And so, you know, you might have the first 30 to 60 days to figure out whether you're willing to waive your due diligence or business conditions, right? Or what, you know, whatever they call it, right? So these reports all take time, right? Like, you know, you go talk to an appraiser and it's maybe four weeks to get an appraisal. So you have to, sometimes you have to be ready to spend it all up front, right away, because otherwise you won't get the deal.
So it's fair to say that 10, 20K, right?
I would say between 10 to 20K.
Right. So back to the lenders. So what else do they want from you?
Yeah, then they're gonna want your net worth, right? They're gonna want backup associated with that net worth.
Bring that back up. Proof,
yeah. Appraisals, tax assessments, financial statements, years of financial statements, right? They can even ask for support for your mortgages, for your lines of credits, right? They're gonna check your credit. They're gonna look at your experience, right? Whether you can, you know, are you planning to self-manage a property, right? They're gonna want to understand the story, right?
So then there's this term called credit worthiness. So what do they measure? Like your credit worth?
They're going to look at your net worth, your liquidity relative to the loan ask, right? That's how they'll determine your credit worthiness, right?
So if you have a bunch of illiquid assets versus a bunch of liquid assets, are you better off if you have a bunch more liquid assets?
Yeah, 100%. Yeah. Yeah, like if you own $100 million worth of land, right? Or you own, you know, $60 million worth of real estate assets that are cash flowing, they might look more favorably on the person who has the cash flowing assets, right? They're going to look at also, how do you own the assets, right? Like what kind of leverage do you have on them? Are you unlevered? Are you levered, right? What levels of leverage with lenders you're working with, right? What rights do they have, right? As well.
Right, exactly. Now, so, and then most traditional lenders like banks have a ceiling on how many doors they'll lend you. And a lot of people don't know. So this is from pure personal experience. I thought, okay, if I have 1, 2, 4, 5, 6, 7, the bank should think that, hey, I'm smart. I got so many cash flowing properties. But no, a certain number, they say, this is too risky. And I said, what? Right? They see you as risky. So why is that? Why would the lenders, traditional bank type A lenders, be so stingy about how many doors they allow you?
Are we talking about the context of like personal lending or?
Well, let's say if you want to buy a bunch of condos, or so many doors later, like for example,
I think on the personal side, again, it's more tied to your, TDS, GDS numbers, right? On the commercial side, I mean, if you have more doors, like that's generally favorable, but if you have a lot of doors because you have a lot of high interest debt, then that's not really that favorable, right? So they're gonna really dig into your overall portfolio cash flow, which lenders you're borrowing from, right?
So what you're saying is when you go commercial, when you go from the personal lending, right, which is under your name or your spouse's name. And one more thing I learned is in my youthful days, I didn't know everything we co-qualified, right? And so let's say bank A allows 11 doors. So I think that's the best some banks will allow. If you have financed them separately, then you have 11, the spouse have 11, then you got 22 doors. But if you co-qualify, you only got 11, right? But there's always ceiling, right? Based on your personal net worth and all that. But what you're saying, Gaurav, is once you jump over the commercial, even though the games are different, there's a lot more price to pay. That is not just dependent on these ceilings, right? It depends on also the cash flow of the building or the buildings, right?
Which is the overall portfolio, the type of debt you have.
Right. Yeah, exactly. Yeah. So let's spend a minute on guarantees. So this is something that is very important, right? But lots of people when they buy it, they didn't even think about it, right? So could it be that the bank or the lender says that no, you don't have enough room to guarantee? Like how do we digest that concept?
Yeah, so I mean, yeah, like commercial lending in Canada, it's very different in the States, right? But commercial lending in Canada, like typically personal guarantees or guarantees have to be provided, right? Outside of the collateral, right? Which is the asset, right? So, what does that mean? So, if for whatever reason the lender were to lose money, right? Like something were to happen to the property, they had to sell it, you had to sell it, you sold it for a loss, then they can go after you personally or, another corporation, right? To recoup that loss, right? So yeah, like the guarantee makes a difference in a deal, right? It probably matters more in a development and construction deal than in a cash flowing deal, right? Because development and construction, there's more risk. There's risk of cost overruns, things going wrong, right? So they really dig into the guarantee in that instance.
Right. And then if you get into a group, then there's group guarantee.
Yeah, there can be joint and several liability.
What does that mean? Joint and several?
So that just means that, they can, let's say me and you get into a transaction, right? And we both give our personal guarantees, right? And we don't limit our guarantees in any way, right? And it's just, it's just the typical language. Then essentially the bank can go after both of us, or the lender can go after both of us, or one of us to recoup their losses, right?
Right. So they go after you individually and collectively.
Yeah, they can decide. I mean, typically, like, lawsuits cost money, right? If you're part of a group and somebody is stronger than the rest of the group, then that person probably has the most risk that the bank or the lender would go after them if they had to act on the guarantee, right? And what can happen is in those situations, you might want to consider signing indemnity agreement, right?
Cross indemnification.
Yeah, which allows you, like, if they go after one person, then that person has the right to collect from the remainder of the group, right? Because if you don't have that provision, right?
Right. So I think that's a little bit far-fetched for some people, but for others, they're right into this phase. But I think it's good to caution people, our listeners, for those of you who are actually stepping into this joint venturing and all that. There could be a trap there. The trap is you put in some money and you got a lot more dry powder somewhere else in your bank or in your investments, in your bonds and whatever stocks. So you have the catch. You pledge your guarantee with a bunch of people, joint and several. Then you go to the next project and say, "Hey, I still got money, but sorry, your guarantee room is like it's topped out." right? So this could be a trap, right?
I think it's something just nice to touch upon, something so people are aware that, hey, if I get into a deal, this is something I should consider, seek some professional advice, right?
Bingo, exactly. Here at Physician Empowerment, we always empower you guys, everybody, to actually get better advice, right, from advisors. Okay, so that's good. So we cover a lot of stuff, and we talk about interest rate and some forecasts for 2025 before we dive into MLI Select. So I know nobody has the crystal ball, right, and I won't hold you responsible, but Gaurav, given what's happening with this looming tariff thing, with the economy, where do you think interest is going, and where's the lending environment changing in 2025?
Yeah, I think in general, like political uncertainty is never good for lending, right? There's definitely going to be some more cautiousness, I think, especially the major banks, right? They might be a bit more cautious, right? You're going to see a lot more focus on liquidity, right? There's so much uncertainty, right? Like this weekend was just a whirlwind, right? We're like, oh great, construction projects are going up, they're going to be so much more costlier, right?
Right.
And luckily we got this 30-day delay right now, right? To maybe figure things out, right? So that's just going to cause some cautiousness for sure. So definitely, looking at some of the non-bank alternative lenders, that's going to be important. And just budgeting, I think, for higher down payments, more equity required in a deal, right? In terms of interest rates, I think there's going to be a lot of volatility. Like just to give you an idea, CMB, which I focus a lot on, right? Canada Mortgage Bond, because a lot of the financing that I do is CMHC based, right? It went down 20 basis points, so 0.2% yesterday. It's up 0.2% today.
Wow.
Right? That's a pretty major swing, right? I think if you just look at a chart over the last, from, beginning of January to now, it peaked at 3.5 and it went down to 2.77, right? So a lot of volatility, right? And that's what happens when you have uncertainty, right? Overall, I don't know. I mean, if I could forecast interest rates, I'd probably be a trillionaire, right? But I don't know. I think there's going to be a lot of volatility. I'm not so certain. I think, if you asked me before we had this threat of the tariffs, right? I would have said, hey, I think rates are going to trend a little bit downwards. We're not going to be anywhere near the lows that we had during COVID, right? But now with this, it's like a yin yang, like it's like a yo-yo, right? Like I just don't know I really don't know what's gonna happen. But I feel like overall, like if you look at it from beginning to end, we might end up being at the same point, but there could be a lot of volatility in between.
But then what people, and I listen to a lot of movers and shakers, podcasters and whatnot, right? They all believe that, well, we're heading in a recession, interest rates are going to go down. Well, hey, if suddenly prices go up by 25%, then there'll be inflation, then they're forced to up the interest rate again, right? So, or they...
Well, no, it's a little bit different, actually. I was talking to someone on the weekend about that. So yes, typically inflation, right? Like when inflation happens, like, they have to raise interest rates to cool it, right? But this inflation is not driven by demand.
No.
Right? It's driven by the government policies, right? So yeah, you could head into a situation where, yes, you have a lot of inflation, but interest rates are actually falling, right? Yeah. So it's a little bit unique in that situation.
It's tricky. Okay, so let's dedicate the rest of the time on this really hot topic of CMHC MLI Select, right? So let me set the stage for everyone. So CMHC is Canadian Mortgage Housing Corporation, is a Crown corporation. So right, and most of us have dealt with CMHC. If this is your first home or your loved ones, your kids buy the first house with 5% down, right? You already have to buy the insurance from CMHC for high risk mortgage, right? And then so in case of default, then CMHC actually supposedly they'll give the money to the lenders, right? So then with this housing crisis, which is East to West Coast, mostly Vancouver, Toronto, right? Then the government have given the CMHC different programs, one of which is multifamily MLS Select, that to incentivize builders, developers, and investors to invest in multifamily because that's the quickest way of housing a lot of new people, new Canadians or old Canadians, right? All inclusive. So then there's a bunch of things that came out maybe not quite 2 years ago, right? But as soon as this incentive came out, people are running like mad house. And because the advantage is so huge in the multifamily space. So maybe, Gaurav, you can walk us through what is MLS Select in everyday terms, how it impacts multifamily investors.
Sure, yeah. So MLS Select, it's one of the programs under CMHC, right? So CMHC, they're the insurance provider. They do have some direct lending programs. MLS Select is not one of their direct lending programs. They're the insurance provider. They're the only insurance provider for multifamily, right? When it comes to loan insurance, right?
Yeah.
And so they MLI Select, it came out in 2022, early 2022. So it has 3 pillars: affordability, accessibility, and energy efficiency, right? And these 3, there's a point system, right? So if you get 100 points, that gives you the max benefits under MLI Select, which is up to 95% leverage. If it's new construction, it's loan to cost. If it's existing properties, it's loan to value, right? And up to 50-year amortization, right? Prior to this program, the max amortization you could get under CMHC was 40 years, right? You couldn't get up to 95%. You'd kind of be capped at like 85%, right? So yeah, the program has led to lots of activity. I think it's led to CMHC becoming a lot more mainstream, right? Like if you look on Facebook, social media, you'll see lots of advertisements, right? For these, buy a $2 million project with 5% down, right?
Wow, that's amazing.
So it's definitely led to a lot of it becoming a lot more mainstream. And I would say like the retail crowd kind of entering this space, prior to this, like there was lots of, lots of private groups that were accessing CMHC financing, right?
Right.
But, and then the other thing that changed was also just the debt service, right? Like on a 5-year deal for CMHC, non-MLI Select, which we call standard rental, the debt service is 1.3, whereas MLI Select allows a debt service of 1.1. Wow. Right. So I call it like, there's like, I don't know, triple whammy effect, right? Like why are the loans kind of higher? Because it's like, well, hey, they allow a lower debt service. They allow up to a certain leverage. The interest rate is typically lower than a conventional deal. And the amortization it feeds into the debt service calculation, right?
So with that, it's an absolute game changer for multifamilies, right? So
it definitely has spurred a ton of activity for sure.
And it's almost overheated, the demand, and then they keep changing the rules, right?
Well, I mean, like it can heat it, like, pocket, like it heats up, like, areas get saturated, and then, the supply gets absorbed, right? I think overall still, we're still really far behind, right? In meeting our targets, right? For housing.
For housing.
Yeah. So, but yeah, like pockets of the area of cities can get overheated for a point in time, and then it just takes time for that supply to get absorbed.
Right. And so there are quite a bit of changes even in the last 2 years, and you and I lived through all of those. You lived through that every day with yourself and your clients. So, and then I think recently not recently, a while back, they even allow construction costs, right? Like not just you finish the building, stabilize it, then you get this money out, right? 95%.
It definitely has spurred a lot of construction financing. There were other prior programs, but I don't think I think the construction financing has definitely gone up considerably under MLI Select.
So for those of us who are in that space, this is, like I say, it's a game changer, and it just changes. It should change your appetite, what you can do, right? So 100K before can do this much, now 100K can achieve a whole lot more, right? And so that should be, and that's the exact incentive the government wants to give everybody to create more housing units, right? And make them affordable, energy efficient, and accessible so that more and more Canadians can live in the house, right? Or in an apartment, right? Okay, so that's good. So people who are interested in this space, what should they do? What
Well,
how
you can
do-
talk to a professional like myself, right?
right.
Who understands the space, right? Who can educate them on it, right?
Interesting. So I have lots of friends and people that I know and acquaintances. They thought, oh yeah, my banker or my residential broker said they can handle that. Is that true?
Yeah, I would say like, look, I was a broker up until December. I switched over to this much larger company, right? That's kind of coast to coast, right? But what I've noticed, I've been in CMHC financing for almost 5 years now, right? And what I've noticed is over the last 1 to 2 years, the amount of experts that have come into this space, right? So-called experts has grown exponentially, right? Because it can be lucrative, right? So people are trying to take advantage, right? And all of a sudden, people used to do just purely residential deals, or they used to do business financing. All of a sudden, they're an expert at CMHC, right? So yeah, you have to be careful who you talk to, right? Like, again, the shop that I deal with, we deal with brokers. There's some really good brokers out there, and there's probably some really bad ones out there, right? And there's going to be lenders with some knowledge and lenders with very little knowledge, right? Because it is a bit of a specialty. Like a lot of the times, a lot of lenders were kind of relying on these specialists to kind of get the deals approved by CMHC. That has changed now because you have to get the deals approved by the lender, right? The lender is the only one who can actually talk to CMHC on the deal, right?
So then there are only specific lenders now?
Approved lenders. They're called
approved lenders, right? So if you go to the non-approved lenders, then it's not going to happen.
Well, the non-approved lenders will probably just tell you we don't do CMHC, right?
Right.
Like for example, CWB, they're an approved lender. Things might have changed now that they got acquired by National Bank, right? But they're typically not an active CMHC lender. You can Google NHA lenders, right? There's a long list of lenders, right? But there's only so many that are actually really active in the space. Like, for example, I'm not sure how active, for example, Scotiabank is in CMHC.
Right. Okay, that's good. So without diving into more weeds, because you can spend a day on this kind of topic.
Thank you so much for listening to the Physician Empowerment Podcast. If you're ready to take those next steps in transforming your practice, finances, or personal well-being, then come and join us at phys-empowerment.ca, PHYS empowerment.ca, to learn more about how we can help. If today's episode resonated with you, I'd really appreciate it if you would share our podcast with a colleague or friend, and head over to Apple Podcasts to give us a 5-star rating and review. If you've got feedback, questions, or suggestions for future episode topics, we'd love to hear from you. If you want to join us and be interviewed and share some of your story, we'd absolutely love that as well. Please send me an email at kmilo@phys-empowerment.ca. Thank you again for listening. Bye.